All right. Well, welcome today. My name is John Mazzara with Remax Results, and I have Matt Martin with Mutual of Omaha Mortgage today, and he's going to talk to us all about reverse mortgages and their applications, both for your existing home, possibly to purchase a new home, both in the terms of getting mortgages and lines of credit. So, Matt, can you tell us a little bit about yourself and your background, and before we get into some of the conversation?
Sure. Well, thank you, John. I've been in the reverse mortgage industry for 20 years now. This is my specialty. I don't dabble in the traditional mortgage business. Uh, really focus a lot on financial planners, realtors, insurance, life insurance agents, that type of thing. Really enjoyed working with the older age group, age 62 and over. And just happy to be here and try to answer any questions you may have, or put away some of the misconceptions that are out there in the internet and the media and whatnot.
Perfect, perfect. And if they wanted to reach out to you post, this webinar, how would they be able to reach out and contact you?
Yeah, I'm local right in the Minneapolis area. You can reach me anytime at 612-910-0778. And you can find me on LinkedIn. And my email is Matt, M-A-T-T, M-A-R-T-I-N for Martin, at mutualmortgage.com.
Wonderful, wonderful. Well, great. Now, can you tell everybody just so conceptually we start off with what a reverse mortgage is and how it might work?
Yeah, the reverse mortgage, the most common one in the country, is what we call the home equity conversion mortgage. And that's the acronym for that is HECM, H-E-C-M. So if you Google that, you're going to come up with the FHA insured program. And that's by far the most common option in the country. FHA insures the program, which means the homeowner and the family are not personally liable for the loan. So if you sell the house with a reverse mortgage in a down market, you're not personally liable if you actually owe more on the loan than what the house can be sold for. So that's the HECM program.
Are you able to do other programs besides HECM?
We do have a jumbo program available. Unfortunately, Minnesota doesn't allow us to use it, but it's more common on the coast. A lot of those jumbo loans are done in Florida and California. And what we mean by jumbo is typically for a home that's worth $1 million or more. Unfortunately, we can't do those loans on Lake Minnetonka or other lake property around Minnesota quite yet. But we're working on getting the St. Paul folks to allow us to do them in Minnesota as well.
So there's actually a restriction. I wasn't aware of that the state has put on the size of the reverse mortgage? Or
yeah, the FHA reverse mortgage we have a limit on the home value, so to speak. It's called the Fha Lending Limit. And that's currently set at $822,000. And what that means is once your home is appraised, if it's worth more than $822,000 today in 2021, the home is not given any extra benefit. And what I mean by that is if it's appraised at $900,000 or $1 million or even more, it's treated as though it's appraised at $822,000. So.
Okay. Now the HECM mortgage, people have options. I believe they can do a draw up to the maximum or less than, or even a line of credit. Can you go into maybe where those applications might be used and why maybe putting a line of credit, especially even if their home is free and clear and they don't intend to use it, why that could really be beneficial to them going forward?
Yeah, the line of credit is by far the most common option. There's other ways to pull out money. For example, a monthly check could be sent to you if your home is free and clear. Let's just say you chose to receive a $1,000 check every month for 10 years. That's what we call a term payment plan, a set number of payments. And if your home was free and clear and you wanted a guaranteed lifetime income stream, for example, for someone that has longevity in the family, that might be a good option, because you could tell your financial planner, you know, I have this guaranteed $700 coming to me every month for the rest of my life. Factor that into my financial plan along with my other investments. And then there's a combination of all those as well. You can adjust the payment plans at any time with no extra paperwork at all. The servicer would basically confirm what type of payment plan, and then the following month you could adjust the way you receive the money. The line of credit, like I said, is very similar to a home equity line of credit that you or I would have. The difference is our line of credit actually grows in borrowing power. And what I mean by that is the program is always assumed that your home is probably growing in value as you live there. So they're giving you access to more credit in your line of credit. And essentially what it is your line of credit is like a credit card, and the servicer is giving you access to more credit automatically every single month as you live there. So even if you start out with a line of credit of $200,000, by the end of the year, if you didn't use it, that $200,000 will probably be closer to $205,000. And then every month and every year after that, you're giving access to more credit. So it's a nice extra bucket of cash for you to use. And the line of credit cannot be canceled, unlike a home equity line of credit can. You may remember during the housing crisis that a lot of people had home equity lines of credit, like myself, and my line of credit was frozen. I had extra credit there, but they froze it at the point where my loan balance was. In our line of credit with the HECM cannot be called due. It is available to the homeowner all the way up to the 150th birthday of the homeowner.
Wow.
Which is a lot different than a home equity line of credit, because you have to typically reapply after 10 to 15 years. And after 15 years, typically your monthly payment goes from interest only to principal and interest, which a lot of times quadruples your monthly payment. So our line of credit cannot be called due, cannot be frozen, and it's automatically going to increase in buying power.
That's wonderful. And they never have to requalify again. So it's
Exactly.
it's done once, and if their credit goes to, becomes terrible, they don't risk losing it because there's never a requalifying.
I'm working with a client right now. They have a home equity line of credit, and it's being called due because they're 76 now, living off Social Security. Both of them are retired, and now they cannot qualify to replace that line of credit with a new one. So we're using the HECM line of credit to replace it instead. And the great thing is they won't have a monthly payment on that anymore. So that will be money in their budget every month. But you do have the option of making payments. So if you wanted to make interest payments one month and then skip the next month when a big ticket item like a air conditioner or a water heater or furnace needs to be replaced, you're not going to be penalized by not making a payment.
Fantastic. Now, I know in the past, the rules have required that both spouses are 62 or older, but I believe that's changed. Is that correct?
That is correct. It's probably best to have both spouses 62. However, we can still do the loan with one spouse being 62. If the older spouse passes away, the younger spouse needs to know that they need to either requalify and put the loan into their name, Hopefully they're 62 by that time. And if they don't want to do that, they just don't have access to any additional money, even though they can still continue to live in the home for the rest of their life.
So they
that
never
was
get kicked out.
that was a fairly new change.
Mhm.
That happened probably 2 to 3 years ago.
Wonderful. Now, the process of getting a reverse mortgage, if somebody wanted to get it, they could use it on their existing home, or they could use it on a purchase. So I'm assuming that the process of qualifying for the mortgage for existing or purchase is the same. Is that true? And then how would somebody initiate, let's say they want to learn more and start to learn about it, the counseling that's required, and just making application with you. How does that go?
Yeah, they can definitely purchase a home. It has to be their primary residence. So they cannot do a reverse mortgage on their secondary home. That's number one. And then as far as qualifying, it's similar to the refinance of a homeowner that's still living in the home. The rule of thumb generally is that they qualify for 50% of their home value on a purchase. If you're older than age 62, for every year that you're older, you're approved for a little more money. However, if we take a $400,000 purchase, typically our loan will pick up $200,000 for the loan balance, and then $200,000 would be cash down payment from the homeowner. And then you move right in and never have a monthly payment obligation ever again. So interest would just accrue on our loan balance of $200,000. A lot of times people make interest payments in the very beginning if they want to keep that mortgage interest deduction and to keep their loan balance low, but they're not obligated to. So you can keep the interest low in the beginning, and maybe when you turn 75 or whatever age that is where you want to stop making payments, you can just stop and keep that cash in your pocket every month instead. Qualifying, very similar to a traditional mortgage. We look at credit, look at income. We're not quite as strict as a traditional 30-year mortgage qualifying is, but we do look at bankruptcies, foreclosures, any tax liens, judgments. We need the letters of explanation on those type of items, and our underwriting's a little more lenient, however.
Can somebody get a pre-approval letter and be underwritten using a reverse for a purchase?
Yep, we get pre-approvals. Typically, we'll pull credit, we'll verify income. Most of the time, Social Security income is enough. If they're both not on Social Security, maybe we'll take 2 years of tax returns in order to verify income. But we can give the pre-approval letter to their realtor or builder for any purchase loan.
Perfect. Now, with regards to that, something you brought up, the purchase, so and the new construction. So let's say somebody's out looking and they want to buy a twin home for $500,000. They hypothetically only have to put $250 down, and the builder, they could purchase it for $500 and then have a house payment other than the taxes and insurance. But the project itself would have to be FHA approved in order to use the FHA HECM product. Is that correct?
That's correct. Condo financing with an FHA loan is pretty difficult. Most of my age group that are buying a one-level townhome or one-level rambler to eliminate stairs. So we're talking in the $500,000 to $700,000 area a lot of times. However, with my financing, they're buying a $700,000 home for $350,000 down in cash. Keep the other $350,000 in your investments instead of locking it up in the house. So.
Mm-hmm. And do you do spot approval on individual projects?
We can do spot approvals, full condo approvals. That takes a good 60 to 90 days in order to get that approved at the Denver FHA HUD office. We have a special department here at Mutual of Omaha that will help
Okay,
get those projects approved. But it is not an overnight deal, that is for sure.
sure. So even if it initially isn't approved, it might be able to be approved. And so we want to get a pre-approval letter to know that what we can do, and then from there seek out projects. Hopefully they're FHA approved already. However, if they're not, it doesn't mean that we still can't buy there. We would just have to go through another step with you initially in your company. And if they approve the project, then we can continue with that builder, let's say, and complete it.
Yeah, the builders appreciate our condo approval department once they understand that, you know, our buyers here with the HECM can buy more home. And the statistic is almost 100% of my buyers are taking the full builder upgrades where all the profit is.
Mm-hmm.
And, you know, everybody wants the upgraded countertops and cabinets and flooring and all that type of thing. So it's a win-win once we get the project approved.
Wonderful, wonderful. And that would give the builder a competitive advantage too, because once it's done, then it's done, and then you're good to go, and everybody else is still waiting, and they may not have that luxury of waiting the buyer. So it would make your project as a builder, I would think, much more competitive.
You know, once the builders understand our program, they really embrace it. It's a great program. You know, we can typically get these new construction purchases done. I don't want to promise anything, but the last one I did was within 21 days.
Wow.
As a company, we want 30 days from the time we get the purchase agreement in our hand and signed by all sellers and buyers.
Okay. And sometimes people, you know, when they retire, they're going from, let's say, a large income to a small income, and all of a sudden they have more month than they have money. And so rather than depleting assets, that's where this reverse could come in really handy. And one thing I know that I believe you can do is you can purchase a multifamily. So if you wanted to live in half of a duplex or 1/3 of a triplex or 1/4 of a fourplex, as long as that was your homesteaded property, you could actually do that and receive income or rents from the other units and not have a house payment, again, other than the taxes and insurance. I mean, to me, that is a perfect way for a landlord or for a senior that doesn't mind being a landlord of sorts to improve their income potential and own something that's continuing to appreciate. Are you seeing that out in the marketplace?
Yes, I am. I'm actually working with a real estate investor right now, a nice fellow, snowbird. He has 3 properties in Arizona, and he wants to put the HECM purchase loan on his Minnesota property that he's going to buy this spring. And he thinks it's best thing since sliced bread. He's going to buy his new home in Minnesota with the HECM loan and only put 50% down and still maintain his 3 other properties in Arizona and be a snowbird and leave this winter.
I like it. I like it. Well, sounds good. And now with regards to counseling, I know because in the past there's been a lot of misinformation, and when I bring it up, sometimes people bring up the inaccuracies of the past. Can you explain the counseling procedure, the mandatory nature of it, how they would get it, and who could attend? Meaning, maybe some of the advisors or their kids are misinformed, and rather than repeat misinformation, can more people get exposed to the true information at that time to make and help their parents, grandparents, or client feel comfortable?
Yeah, most of the HECM reverse mortgage clients do the counseling right over the phone. FHA mandates this counseling. And the counseling is basically like an hour to 2-hour session where the homeowner will sit at the kitchen table with this phone on speakerphone, and they'll have a conversation about the numbers, making sure the homeowner is qualified for the loan. and that the homeowner knows exactly as far as the numbers that are available. And for the older generation, I've done these loans for people in the 90s. Actually, my oldest client was a 103-year-old.
Wow.
And we just want to make sure everybody is taken care of, and that no family member or person out there is taking advantage of our clients. So it's a good service. It may or may not be free. Some counselors charge a fee. The maximum that they can charge is $150. But they're nice people. It's done by a nonprofit, typically like Catholic Charities Counseling or Lutheran Social Services Counseling, Family Services or Jewish Family Services Counseling. So it's a good service, good educational session for everyone. The kids can sit in, the advisor could sit in at the kitchen table and listen. And the counselors mail a certificate when it's all done that I need in order to go ahead with an application and to order an appraisal and title work, and just start your typical mortgage processing after that. The counseling is what sets us apart from a typical refinance. Once the counseling is done, we're just like a traditional mortgage refinance with an FHA endorsement on it.
So if somebody came to you and said, hey, Matt, I'd like to get a mortgage, would you say, okay, that's fantastic. You'd give them some background, and then would you send them to the counseling, or would you start the application? Is it the chicken or the egg? Which is going to come first on that?
Yeah, in the state of Minnesota, which all 50 states have their own opinion and different process, but in Minnesota, we cannot do much of anything other than talk and go through the numbers until the counseling has been completed. Once we have the certificate, we can go full speed ahead, so to speak, and do the application and start your typical mortgage process.
Okay. And I know this could probably change too, but once somebody has it, would they be receiving documentation from innocent place? Would their statements be coming from your company, or would you be selling it off on Wall Street and it's owned or serviced by a third party, or what type of documentation are they receiving going forward? At least
Yeah, good question. They still get a mortgage statement just like any other mortgage. The only thing is they don't get an envelope in there, because most people don't send in any check or cash to us, because there's no monthly payments needed. Mutual of Omaha is servicing about 50% of our loans right now. And as an industry, there's 4 main servicers that field calls and send out mortgage statements every month. So when it comes to servicing, it's not quite the same as a traditional 30-year mortgage, because on a traditional 30-year mortgage, you're sending in a check every month. And we all know that sometimes when you change servicers, that the check can be lost in the mail or lost somewhere in between. So I try to give our homeowners a peace of mind that if your servicing does change, which typically only happens once, that is not necessarily a huge deal, because you're not mailing in a check. You might get a statement from a new servicer at one point, and your line of credit isn't going to be damaged, or there's no concern about the line of credit, because FHA is involved, and if there was any concern about that, FHA would step in, because FHA is actually in second lien position in front of the main lender. And what I mean by that is the lender's in first lien position, FHA is actually in second lien position. So if you ever pulled up title, you'd see 2 identical mortgages on the home.
Oh, I didn't know that. Now, with regards to liability for any overage, so let's say, and I don't think we're ever going back, but I can't say never, of course, to the foreclosure crisis of the 2008, 9, 10, and even 11. So during those years, real estate values fell by anywhere from 25 to 50%. And some people at that time were underwater on their regular mortgages, but now with the reverse mortgage and the negative amortization associated with it, there were many of those that I saw that were underwater as well. Now, if that was either foreclosed on or that person had to sell or leave their home, it was either a forced sale due to death or, due to they had to go to a nursing home or something. Who's responsible for that negative amount of equity? Should there be negative equity at the time of that property sale? Is it the heirs? Is it the people? Or is it nobody?
But, well, I actually had this circumstance back in 2010, where one of my homeowners that I did a loan for in the early 2000s, he was in his low 90s, I would say 92 or 93, back in 2010. He called me and said, I'm selling my home. It's a townhome here in South Metro, and I still have $20,000 sitting in my line of credit. However, I know that my townhome was probably underwater. And he asked, what should I do with that 20,000? And I just told him, you paid for the right to have that line of credit for the rest of your life. You paid that insurance premium. And unfortunately, the housing market took a turn, but that money's still yours. So what he ended up doing is he took that 20,000, he put it in his savings account, moved in with his son, which I actually did a reverse mortgage for his son as well, which was a real unique and cool situation, doing two loans for the same family. But yeah, he put the 20,000 in his savings account. He moved out, and he listed the house with a realtor, and the realtor sold it. And I think he ended up being upside down by probably $30,000. So there's no liability with these loans because you're paying that insurance premium not only up front in the very beginning, but on a monthly basis. There's a 0.5% going to FHA currently in the form of insurance too.
Is that insurance paid for the life of that line of credit or the mortgage itself? Is it accruing, or is there a point where that ever falls off?
The 5% currently accrues as long as you have the loan. And that's just 0.5% of the interest rate that is added to the loan balance.
Okay. All right. Interesting. Now, creditor protection. And I don't know if you know about how this would work either, but let's say somebody is sued and they get a judgment, or they declare bankruptcy and they want to, they have to sell the house, depending on how they do that. How does, and if you don't know, that's great too, but how does any of all of that, and I'm being very vague, of course, because I don't know the scenario that we're making up, but how would any of that be affected by having a reverse mortgage?
It's interesting you brought that up, because I just had a person in the East Metro here last week ask me what happens if I declare bankruptcy in a year or two, what happens to my line of credit? And I reached out to our head of underwriting, and he said, your line of credit will probably be frozen until the bankruptcy is resolved, so we know that the HECM is not part of the bankruptcy. As far as liens and judgments, any lien would be subordinate to our loan, because obviously if the reverse mortgage is filed at the county, our mortgage would be the first lien and anything else would come behind us. A lot of people have question like that regarding a nursing home or maybe a Medicaid lien. But if we're put in place first, we're first.
Mm-hmm.
And actually had another lady that was on Medicaid, and the counselor, reverse mortgage counselor, said she wasn't qualified based on being on that type of assistance, which ended up being entirely and completely wrong. I actually did the lady's loan, in the little sticking point there is that you just have to make sure that your liquid assets in your checking account and savings account are within the Medicaid threshold. And what I believe is $2,000 or less currently. It could be up to $3,000. I'm not exactly sure right now. But we went ahead and did the loan for this lady. She lived in a small town home in the South Metro. And I just told her, when you have money taken out of your line of credit, that you need to spend it. Because if you get audited and you're over the Medicaid threshold, you'll probably be taken off of that type of assistance. So we set up the reverse mortgage. She had a nice line of credit, which is a loan. It's a liability. It's not an asset because you have to pay it back eventually. So Medicaid could not take that line of credit as an asset on her assistance. So we set up that line of credit, and I believe she had 45 to 50,000 sitting there in the form of a line of credit to help her enjoy her life.
So she could supplement, she just had to make sure it went away within 30 days. So it didn't show up in her account. Just you take it and use it.
Exactly. If you take money out of your line of credit, you take it out and cash it out or do whatever immediately as soon as it hits your bank account.
Do you have check writing privileges on that line of credit? Like you get a checkbook, or is it you have to do ACH transfer requests or pick up the phone and say, send me some money?
It's typically ACH. You know, our technology is starting to catch up with the 1990s here. So rumor has it that we're going to have a mobile app pretty soon where you can request money out of your line of credit on your mobile device and have it deposited right into your checking account within a couple business days, maybe even 24 hours. Currently, I tell people that if you want money, it's probably going to be in your checking account within 4 to 5 business days. By law, it has to be in there within 5 business days. So hopefully with our mobile app, it'll be a little quicker, a little easier. In today's world, you're getting a check in with your monthly statement if you have a line of credit that you need to fill out just like a check and request money. And then either fax, email that in, or snail mail that check in order to request money. But it's only going to go into the one checking account that we get at the time of closing, because we ask for a voided check to have on file to establish that ACH.
Okay, interesting. What are some of the questions that I didn't ask, Matt, that I should have asked or that you would like to share information-wise regarding reverses and the process and thereof?
Well, I have a couple more affluent clients that I'd like to share with you.
Certainly.
I received a referral here in the last year from this financial planner. And this customer is 64 years old. He's just retired. And he called me and asked me, can I receive a check for $1,000 a month for the next 10 years out of my home equity? Because I want to put off touching any of my investments for 10 years. Well, the financial planner is happy because that's more accounts under management that aren't going to be touched for 10 years. And this is all, this $1,000 a month in home equity is tax-free cash. So he's just going to let his investments grow and grow for 10 years and then turn off his reverse mortgage, so to speak, and start tapping into his investments. So over that 10-year period, he's only going to need to take out the required minimum distributions out of his investments, which should be a huge win for him in his retirement plan. So that's a pretty unique situation.
Well, just to piggyback on that for a second, you know, every year that you defer receiving your Social Security benefit, it goes up by 8%. So somebody that, you know, needs that income but doesn't need, you know, but doesn't want to start it, would rather get their 8%. if they were to basically, they effectively would be arbitraging interest rates if they borrowed money from you through the reverse. And I know rates change every day, but can you give me just a small range of where, if I was to do it, let's say today, what kind of an interest rate I might have on my reverse mortgage?
Yeah, I just quoted a gentleman 2.6%, which is a potentially monthly adjustable, which some people get concerned about the monthly adjustable. However, our index on our adjustment is the 1-year treasury. Well, the 1-year treasury is sitting at 0.08%. So even if it doubles, the index doubles, you're talking, what is that, 0.16%
Sure.
on your index? So, and what I do when we sit down for our application and counseling is I'll lay out the index and what they've been over the last 20 years to give the homeowner the peace of mind of what to expect. And then we have a fixed rate right now at 3.8%, which is amazingly low. It's the lowest that I've ever seen in 20 years.
Does that include mortgage insurance in both of those quotes, or is that another half a point on top of those?
That's a 0.5% added to that.
Okay, still fantastic. So if you took 3.8, you added 0.5, you're at 4.3, and if Social Security is giving you 8, that's almost a 4% arbitrage difference in having your benefit accrue. And so I could see that, or your investments, if you're able to get higher yields from some of your investments, certainly, again, worth arbitraging, or at least taking a look at it. So.
Absolutely. And I have one other scenario I'd like to run by you.
Yes.
Another referral from a financial planner, a younger couple. And what I mean by that is she's 63 and he's 65. Small business owners. They live in a home worth $500,000 and they still have $200,000 left on their mortgage. The majority of the time we're paying off some type of mortgage or home equity loan and just relieving the homeowner of that bill every month, putting that cash that they're sending out to the bank or mortgage company back into their budget. Well, flipping the scenario, this client, they want to continue to make mortgage payments as long as they're working. So they're going to send in a check of $1,000 a month to the mortgage, which is the reverse mortgage that we're paying off, the old one. And that $1,000 that they're sending in every month, not only is that going towards their interest on their reverse mortgage, but the $1,000 will be credited towards their growing line of credit every time they make a payment towards that interest. And they're currently making a mortgage payment of $2,000 roughly. So what they're achieving is an extra $1,000 in cash flow from going from a $2,000 mortgage payment to $1,000. And they're getting the flexibility of making that $1,000 payment every month whenever they want to. It doesn't have to be in the first of the month, doesn't have to be in there by the 15th of the month. And you're getting the flexibility of skipping a month without any penalty. And all that money can be recouped out of the line of credit that is growing anytime they want to, with their idea of quit paying somewhere around their 70th birthday when they start taking the maximum Social Security.
That's fantastic.
It's a lot more flexible than people give us credit for.
Yeah, really a good financial tool. One of the things too, I know that I think they've changed is the cost associated with it. Can you just cover what would be the cost of obtaining a reverse mortgage, either the fixed or the line of credit?
Absolutely. The 2% mortgage insurance premium to FHA is non-negotiable. FHA is going to get that insurance policy financed from day one and then ongoing. And then you have your typical state, county mortgage type of fees. and every state's a little bit different. Of course, in Minnesota, we have the mortgage registration tax on every mortgage that's filed. And a lot of times, depending on what interest rate that the client chooses to go with, because some of them choose a higher rate with lower fees, and sometimes people want the lowest possible interest rate there is in the marketplace, and the lowest possible interest rate is going to come with some type of points. So 2% of the home value is the insurance. Then you have the other Minnesota taxes and fees with a possible point or mortgage origination fee included.
Okay. In the MRT, the mortgage registration tax, now, even if they don't take a draw, I mean, can you explain how the value of the future mortgage and the MRT associated with that is, is charged?
And the Minnesota registration tax is based on the client's approval amount minus the more upfront mortgage insurance premium. So if they're approved for $200,000 on a $400,000 property, there's going to be an $8,000 mortgage insurance premium that's financed. So that $8,000 is 2% of the home value. So that's the big insurance policy. And so we take the $200,000 approval amount, subtract $8,000 out for the MIP, which brings your amount to $192,000. And then we times that by the mortgage registration tax of 0.0023 if you're outside the metro, and 0.0024 if you're in Hennepin County or Ramsey County.
Fantastic. Well, that was a great explanation of that.
So if that doesn't make your head spin.
Yeah, well, I'm in the industry, of 35 years. So for me, it's like we're talking shop, but somebody watching this might be going, "What the heck did they just say?" So now I know having worked with you, and my wife has worked with you for many, many years. You're very approachable, very, very low pressure. I'm assuming if somebody wanted to reach out to you, you would be open to fielding questions and taking and helping them make the right decision to go forward, yes or no, and providing ancillary documentation if they needed it. Is that correct?
Absolutely. I was talking to some clients, actually 2 daughters and a mother and father on Saturday, and I know I'm competing against 2 other lenders, and the 2 other lenders are out of the state. And I just told them, I want to make sure that you're taken care of. Even if you don't go with me, I'm here for you in the future. Call me anytime. I just want to make sure that our homeowners are taken care of, and to do the best I can to make sure this industry doesn't have any issues down the road. I've been in this industry for 20 years, and I still get calls from, the daughter or the niece. At the time grandpa or grandma passes away, they typically have questions. And I'm always here to field calls.
Wonderful.
Even if I'm not your loan
fair
officer on file.
Very cool. And then now, for yourself, as far as being licensed to do loans, you can do them all throughout Minnesota, correct?
Correct.
Can you do other states as well?
I can originate in every state but the state of New York and West Virginia. And how that's handled is I co-originate the loans with one of our fellow Mutual of Omaha loan officers that are located in one of those states.
Okay, so if somebody, like say, is a snowbird, and they go down to Arizona or Florida or Texas, and they spend their 181 days over there, so they're a resident of those states, but they come up here in the summer and they visit with you and they say, I would like to do a reverse on my home in Arizona, my primary residence, or Florida or Texas. That's something you could help them out with.
Definitely. I've closed a lot of loans in Florida and Arizona. I know what the fees are down there.
Okay.
Florida is pretty expensive because they don't have a income tax, but they tax the mortgages pretty heavily down there. So
Oh,
I
interesting.
closed a lot of those loans.
Okay, wonderful, wonderful. And then now I know there's the big box banks, and sometimes, that's where people get regular loans. But I don't believe the big boxes are doing reverses at this present time. And so I know sometimes the loan officers at those banks aren't aware of that product or that knowledge, and so they poo-poo it because it can't put any money in their pocket. Uh, and that gives people the options then of doing loans with the commercials and the people they see on TV. But the advantage of working with somebody local is you're a national company with a local representation with the face, and you would meet with people both individually, or if they're uncomfortable due to where we're at right now with the COVID stuff, you would do Zoom meetings like we're doing now, or virtually, however, through the phone. And I think it's a much better experience. And you would just like to touch on that at all?
Yeah, in 2020, it was kind of an interesting year here, originating these loans, because previous to that, I've always been the one sitting at the kitchen table with the daughters or son and mom and dad, going through the numbers and telling them what the benefits and pros and cons, so to speak, are. People have a wide range of sensitivity to the virus. I had a family that accepted me with open arms and came in and sat at the kitchen table with the mask on. And then there's other folks that, I'm not going to do this until I get my vaccine. Don't call me and I'll call you. And then there's the other people where I would call them with my cell phone in the driveway and basically hand off the application on the front step, and then come back in an hour or two and pick it up and see if there's anything we need to talk about. And like you talked about Zoom, we've done that, and we've done FaceTime, sitting the smartphone right on the kitchen table, and I'll be on the other end on my FaceTime. So it's been very unique.
Wow. Well, that just is a testament to your ability to wanting to provide great customer service and having that flexibility to give people to meet them where they're at and get the loan done. So that's great, Matt. There aren't any other questions that I have. Would there be anything else you'd like to share other than of course, again, who you are and how people can reach you?
Well, there's a wide range of resources out there. One of the independent third-party resources that I would like to give, and it's part of the American College, which I know you're familiar with. That's Tom Davison, the toolsforretirement.com. And he blogs about the HECM program quite a bit, and he's a retired financial planner. If I were to guess his age, he's around 70 or so, and he's been a nice advocate for us. And I reference him when working with financial advisors because some of them recognize the name and definitely recognize the American College. So that's a good tool if you want some independent third-party advice. And you can always reach me at 612-910-0778. And you can email me any questions you want. Gladly return them, even if you're not necessarily serious or you're just kicking the tires. You can reach me at mattmartin@mutualmortgage.com and be happy to help.
Wonderful. Matt, thank you for taking the time today. It's been wonderful visiting with you. And anybody that's out there listening, give Matt a call. You'll be very happy you did. Have a wonderful day. Thank you.
Thank you.